Year over year, comparable numbers were impossible. Commodity inflation ran rampant, and economic growth slowed, just as the consumer paused after spending furiously in 2021, leading to this headline across multiple media outlets. Here it is. The S&P 500 just posted its worst first half of the year since Richard Nixon's presidency in 1970. And many investors worry it is yet to hit bottom. I'm Chris Parrish, Chief Investment Officer at Oak Harvest Group in Houston, Texas. And this is our investment team's midweek release where we examine a news item, headline, or story making the rounds from publicly available sources, and we ask, is it news or is it noise for your money? This week's topic is the stories about the historically bad first half returns for stocks and bonds that investors endured this year and the comparisons being made to 1970. Yes, the data doesn't lie. The first 6 months of 2022 were abysmal for stock and bond investors. We had low expectations for the first 3 quarters of 2022, but the markets even underperformed our curb your enthusiasm view for a volatility and correction-laden first half. The widely followed S&P 500 fell almost 21% amid expectations of high inflation and a hawkish Federal Reserve, whose rate hike plans could push the U.S. economy into a technical recession in the first half of this year. The last time the S&P 500 fell this much in the first half of a year was 1970. The data doesn't lie. They do look very similar year to date. Back then, Richard Nixon was president. In the first half of 1970, which was also a midterm election year, inflation was running hot back then. Back then, the S&P 500 fell minus 21%. The first half of 2022 was also down, almost exactly, minus 21% with high inflation. However, back in the second half of 1970, the market reversed those big losses to gain positive 26.5% off the summer lows into the year end. The stock markets closed the year almost exactly spot on flat for the wild ride of 1970 with volatility all year. In total, the market rose 44% from its halftime closing low in 1970 throughout the first half of the second quarter of 1971. This top in 1971 was also up 14.5% higher than where the market started the year in 1970. This was also during a period of high inflation, lousy politics, and global uncertainty. Viewers, doesn't that all sound very familiar? I hear current strategists bringing up the comparison to the 1970s all the time. My purely data-driven response would be, let's hope so. New all-time highs on the S&P 500 in early 2023 and more gains thereafter. The history of the markets and the final punchline is often left off these historically dire comparisons made on TV. Are the reports of stock market declines for the first half news for your money? Of course they are. Are the analogies of prior decades in the past, like 1970, news for your money? Possibly, but remember, always look behind the numbers and see if you're getting the whole story or if your very important punchline is being conveniently left off. At Oak Harvest, we think our clients are best served by us helping them plan for their future needs instead of focusing on the past. The future is always uncertain in the stock markets, and that's why our advisors and retirement planning teams plan for your retirement needs first and your greed second. Give us a call to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. I'm Chris Parrish, and from the whole team here at Oak Harvest, have a blessed week.